Good afternoon, everyone. Dr. K here in London, sunny London for a change, and Gil over in Playa del Rey.
Usual place,
Um,
yep.
yeah, fresh air, fresh ocean breeze. Gotta love it. Used to live in Hermosa Beach and couldn't get enough of that. At any rate, we have an interesting market on our hands. We had a high volume reversal day yesterday, and then today we had a gap down on more negative news. First of all, as we all know, Bernanke had things to say, as well as other Fed governors about slowing QE in the coming months. And then Japan had also indicated they were aware that the amount of QE they're pumping out is quite high, leading some to speculate they too may slow it down. And then we of course had weak economic data out of China, so consequently the markets gapped down almost 1% at the open. They are struggling to find their floor, to find their footing rather, and right now it looks like QE obviously is still pumping away across many central banks. So the argument is that the market may do what it's done before. It'll find its floor and then head higher. However, as we know, price volume rules all, and right now price volume is pretty bearish. A high volume reversal is one of the more bearish patterns you can see. So the question is, stay with the price volume action. The market direction model and the VUVXY model went to cash just for safety purposes because this is a bit unknown territory in terms of volatility. I think volatility would increase easily given the news out of Japan, China, and Japan and the Fed in the U.S. mainly, because both of those entities have considered the possibility of slowing quantitative easing. And we all know that the market got to the current levels because of quantitative easing. So you start to drain the punch bowl, and the party starts to get thin, and people start to worry. And we're seeing that through the price volume action of the major averages. So it's better to be safe. Take your profits. MDM's signal, which occurred weeks ago, was a profitable one. The UVXY was slightly negative. Slightly is relative, of course. UVXY is very volatile, so if it's down single digits, that's slight. But nevertheless, it was down because this indicator basically was very slow to move lower as a result of where the VIX has been, and it's been kind of pacing a floor, as you can see, and now is rising higher on the negative news. So all that's to say, definitely you play defense, especially in these kinds of markets where you have this kind of price volume action. Prior to yesterday, we had a nice steep increase in the majors, and some of the leaders were starting to act properly for a change. But unfortunately, the party's over before it's even had a chance to get going. So it's good to play defense in this environment. We saw gold and silver, the precious metals. They are higher today after negative reversals. It's going to be tug of war with precious metals simply because there's lots of cross currents as usual. And we see, for instance, the interest rate argument that if interest rates head higher, that's bad for the precious metals. But on the other hand, if we have greater uncertainty in terms of interest rates going higher, namely European countries that can't print money, therefore they're going to stumble more than they normally would, that creates uncertainty in Europe. And of course the uncertainty as to what the Fed's going to do in the future and the Bank of Japan is going to do in terms of quantitative easing, those are big wild cards and forms of uncertainty. So that could actually bolster the price of precious metals, since we all know that they're safe havens when things are volatile and worrisome and uncertain. But anyway, that's all I wanted to say about the market averages for now. Gil?
Yeah, I think it's a good idea to go to a neutral signal on the model, given the action in the NASDAQ and the other indexes. Look at the S&P 500 did the same thing. But they're coming up off the lows, and I was on the chat room this morning, and I know yesterday I was shorting stocks, and those of you who are in the chat room were probably aware of that, hopefully, if you were paying attention. But what I was telling people this morning though is if you're trying to short this morning, you're late. and you're coming in here thinking you're going to score big on the short side, and the reality is, if you look at some of these short sale targets I've been working, you're late, because we were talking about LinkedIn yesterday as a short, and notice what it does this morning. You undercut this one, I think it's like a 170.87 low or so here, so that sets up a logical rally. So that's actually a short-term cover point, and the stock is now rallying back up. Maybe it heads to the 50-day moving average, which is up here at 179 and change, or maybe just dies here on the buying on this little rally. But you can get a sense of the positions of stocks that you might be campaigning on the short side. Another one I was short yesterday was Apple. And notice what it did this morning is it ran right down to the 50-day moving average and bounced. So from my perspective on the short side, that puts you on alert in terms of not trying to jam the pedal to the metal on the short side thinking you're going to score big. You're coming right off the peak on the indexes, and while the market's maybe going to be sloppy for a little bit of a period of time here before it either finds its footing and tries to go higher, or it simply just starts to roll over and gets into more trouble, you know that you're pretty much on a tactical basis on the short side, because you're just trying to hit these things when they come down to logical cover zones. You have to be on alert for them to be bouncing there, and then you're trying to take profits, or at least not getting aggressive on the short side there. So, and I think that's really the critical thing to keep in mind here. If you're trying to play the short side, you have to be more anticipatory than jumping on the bandwagon when everybody sees the stocks start to break down. And I'm just noticing, watching these things trade, like the Apple, which I'm looking at maybe shorting again, but we're watching it on the handy dandy 620 chart, and you can see it's started to break down a little bit, but it's not really giving it up yet, and I think that's all going to depend on what the market does. So it's possibly shortable in here. You could take a position and see if it reverses. So, but tough one to call right now. I think the market's not kind of in flux. LinkedIn as well. Let's see. Let's take a look here. Just barely starting to flip below the line here, so maybe this is going to roll over right now. So maybe these are possible places where you could test out a little bit of a short position. I don't have anything in these right now, but I'm kind of watching this, and they'll probably blow apart right in the middle of this webinar when I'm not looking. I got this chart up. It's possible to put out positions here, but I notice the market feels a little bit spongy in here. You're seeing a lot of stocks jacking up off the lows this morning, and some of them off of extreme lows. I think one of my favorite ones was, nope, that's not it. This one, I saw this one on the chart. I love that. Too bad you couldn't buy it right there and try to catch a falling knife and score big on that. But that's the sort of thing you're seeing. Some of the stocks that I like, 3D Systems kind of breaking down into its base and now bouncing back up to the 10-day. Stratasys, whoops. Doing the same thing. I don't like the fact, though, that you have this breakout here and it sort of failed on that. That looks a little bit feeble to me, so I'm a little wary of some of these stocks. What I noticed, remember, we were talking about this 2 or 3 weeks ago, where it seems like you got some of your best moves in stocks were on these pocket pivots coming around and rounding out these lows of the basis, and there were a whole bunch of them, Stratasys being one of them, but one that we all played, and there were plenty of alerts on these, was 3D Systems, and notice how it had the best move coming around, and others that I talked about on this webinar. Look at the move that Goldman Sachs had, very nice move straight up. When it breaks out, that's when it runs into trouble, and that almost seems to be the case where the breakouts are just too obvious, and by the time they get to that point, they've been shooting higher. I think other ones we looked at were NSM, your best move was here. Now in the Bible, gap up, which is, I guess, right here. Yeah, coming in, though. But, what are you up? You're up a few percent on that position, and it's not like you're making big money after buying the Bible gap up. You're watching this come right back into your face. And so it seems to me that you have to think a little bit outside the box, and, I've done very well over the last couple of weeks playing stocks exactly like this, and there's been a whole bunch of them that have done this. Even Salesforce.com, big move all the way up. But again, if you're trying to buy in here thinking it's a cup breakout, slam, you push right back into the 50-day moving average. And this is kind of like the way this market acts. And I know I've gotten some emails from people telling me they're buying breakouts and then the stocks go nowhere, and then finally they break down and they sell at a small loss. And I think that's the case for a lot of breakouts. You have to be using pocket pivots, and in this environment, I think a pocket pivot buy point coming up around the lows of a base as it rounds out is a lot more potent than buying the breakouts with the rest of the sheep, who see the breakout and operate on the old rules or the classic old O'Neill-style rules of just buying breakouts. I think you have to be a little more anticipatory in terms of buying pocket pivots. And if you've been following these, on the reports, I think some of these have worked out pretty well. And I do think you have to become wary, when they're jacking straight up, because if you look, say, for example, on 3D systems, that's pretty constructive, straight up for 4 weeks basically, and you get up into a weekly chart. Now you're pulling in. The way I look at this is you could sell in here, take your profits if you bought lower in the pattern, and then hang out and wait for a new buy point to show up. Because there will be another either pocket pivot or a breakout from a handle area, and so I'm more inclined to want to play that way and take my profits as they come. So those of you guys who've been on the chat room, I've been talking about my approach has been to be very active. I know I get these questions. Sometimes I wonder where they're coming from about people asking me whether I'm adding to or reducing my positions today, whatever the hell that means. I'm either in or I'm not. That's usually the way I approach it. And I'll come in with 100% positions very quickly and then blow them out. Well, if I get 15-20% on them, I'm going to blow them out and take that gain. And then other people are asking me, how do you pyramid short positions? Well, I don't really. Like LinkedIn yesterday, last couple of days it's been stalling, and you can see the stalling action up in here. So yesterday or a couple of days ago there was a buy recommendation, with a 225 price target. I think they're dreaming. And you use a 620 chart to come in and short it intraday, and then you get this break. So I'll take that, and let's see how it sets up coming up into the 50-day moving average. And I think that's really an approach that you have to take in this market, because with the QE still lurking out there, you're subject to these rallies. And even in the chat room this morning, people were talking about, you could easily get a rally, and it would totally make sense because everybody's been conditioned to buy these. The question is how it plays out and whether institutions use the conditioning of the crowd to buy into these pullbacks to unload and distribute stocks. So, but right now you're seeing a little bit of a choppy action. I think you're more or less in sort of a no man's land, and there are tradable opportunities. You could have gone long a couple of things this morning and made some money, trying to trade them. GMCR coming down, but it's basically catching a falling knife. I thought Tesla was interesting this morning because it really held in relatively well, and it's holding up despite the fact that it seems like more people want to come and short it. I don't know why people want to short a stock in this position. I certainly would, and you're not the only one with this idea, because there's still a huge amount of short interest in the stock, and I wouldn't be surprised if the next numbers that come out, which I don't think, have they come out yet, the short interest numbers, Dr. K?
Let me check here.
No, we're still looking at April 30th numbers. You can find them on the NASDAQ. If you go to the NASDAQ site, maybe I can pull up a browser here. Let's go. I'm going to show you guys, for those of you who don't know how to do this. If you go to the NASDAQ site, this is a NASDAQ site. You guys can see this. Can you see this, Dr. K? My browser with the NASDAQ site?
Yep, all good.
Down here, quotes and research. Click on there. It's going to bring this down. Short interest. And you can add in a whole bunch of symbols here. So let's just look at a few. Tesla is one, and you're looking at 430 is the last number. You have 27 million shares of short interest, 7.96 days of short interest there. And what I want to see is what the numbers come out for 5/15, which would be May 15th. But that's how you can find short interest for those of you interested in looking at that. And it'd be interesting to see if there are a lot more shorts. I'm just watching things trade right now, and I don't get a sense that they necessarily, you got to buy off the lows, and I think everybody's kind of looking around and wondering what's going on. And some of the shorts, you can see Apple starting to work now a little bit on the downside using the 620 chart. And let me just go over there. You can see it's starting to come in a little bit here. So this could, this could be your shot right here that we're talking about in real time. So, that might work out. LinkedIn, another one we're keeping an eye on. Let's see how that's doing right now in real time. Starting to look like it wants to break down, but not really. So, There wasn't a lot of volume, I believe, in the stock this morning as it was coming down. So, you know, it's a little bit touch and go on the short side, and I think you have to be opportunistic, looking to short into rallies and then covering when you see logical cover points, you know, when you undercut a low like it did this morning, and if you're playing very aggressively like I might. Although I have to admit I didn't come in with heavy positions this morning. I bagged profits going into the close yesterday and decided to play it safe because I wasn't really sure what would happen this morning. Of course, with Japan dropping 7.3%. Hey, Dr. Hay, what's a great ETF for tracking Japan? You got one off the top of your head?
Actually, you know, when I found the Amex tracker, then I just used that. But let's see, I'll find one right now.
Okay.
Let's see, let's go with, well, there's quite a few out there, and this is from May 7th. But DXJ, and, well, of course, there's EWJ. That's the one I use.
Yes, EWJ. Good old EWJ. That's
So
a nice break. I like that break. So, what is it? Like, didn't they announce, like, QE, kamikaze QE back here, and you had this nice grind to the upside, and then kaboom.
Right.
Which, you know, that tells me that QE, you know, you can't really trust QE markets, I don't think. And that's one of the reasons why my approach has been to trade actively and take profits when I have them, and also think outside the box by buying into these pocket pivots, these bottom fishing pocket pivots off the lows. So.
And markets are going to get rattled whenever, you know, you have a minister or a representative saying that the QE flow may be slowed, and that's what happened. You know, that caused obviously an issue in Japan, and the market's been up something like, you know, more than 2/3, something like 67% since it started its run. So,
Right.
You know, it's going to be very sensitive to any negative news regarding QE.
Right. Give me a second here. Let's see here. Let's go through some of these questions. Here's one for you, Doc. Hey, when the model goes to cash pre-market, what price does it assume as a closeout? The highest price, I'm going to say. What's your answer, Dr. K?
Oh, no, we take the opening price as that's how we track it. So if it's
Right.
pre-market, then we're not going to take a pre-market price. We're going to take the opening price of that day.
Okay. NASDAQ had a big outside reversal day on 225, and that turned out to be the low, somebody says. 225 would have been, oh, wait a minute. Let's see. There, yeah, but that didn't come off the peak. That came off down here. But yeah, that was, you know, QE market found support at the 50-day moving average and then turned around and went higher. So, but, you know, I don't think you can necessarily compare apples to oranges here. I think whatever the market's doing right now is whatever the market's doing right now. And that's what you operate on. You know, trying to say, well, it did this 2 months ago, and now it's doing this now, you know, blah, blah, blah. Yeah, maybe so, but I think you just have to go with what's going on. You know, you saw a lot of the leading stocks get hit the last couple of days, and I think after today, you're mostly seeing rebounds from these declines off the peak, and so there is a logical case to be made for sort of a reflex rally, and it becomes a little bit too obvious. And the other thing with going short is that you don't want to necessarily go short off the peak unless you're anticipating it like I was yesterday, because you could sort of see it happening. For those of you who are hanging out in the chat room with me, you could see it happening during the day, and so you come in after things using the 620 model, and I think you know, that's what you're trying to do. So the thing is, you might take more time in here to come off. We're starting to see the market come off a little bit more. So let's see. I'm checking these guys here. Okay, my prediction is Tesla's going to go to 100 even if the market tanks, just because everybody wants to short the thing. Look at Apple working a little bit. But basically, if you look at this on an intraday chart, let's just watch what's going on. Let's look at the NASDAQ, for example. Am I getting that right? CompQ. There we go. on an intraday basis, you gap down and you're basically working your way higher. Are you going to reverse off of this? It's hard to say, you know. So it may just chop around in here, and you're going to try and get short every time you see it get weak, and they're going to push you back in, and this could go on for a period of time. So I think that when you're looking at shorting a market, you have to wait for the first break off the peak and then subsequent rally, and that's really your best shot. And then you're using the 620 model to try and catch things on the bounces, like we're showing with the Apple. You can see the Apple starting to come off now. Let's see. Whoop. I lost my chart. So you can see it's starting to break down on that basis. You can see LinkedIn also. So this might be where you test some shorts out on this. So don't expect a lot of success right off the bat. You might just end up getting pushed out. So I think that the meat of the short side was going into the peak yesterday, catching that reversal heavy, and then coming in and covering these things on the basis of what I was showing you guys a little bit earlier. Now you see the index, what it does here. So I think I'd be careful on the short side. Anyways, any shorts on the watch list other than Apple and LinkedIn? Not really. I'm still kind of developing that list. You know, I was looking at Amazon. Let's go to Amazon here. Pull it up on a daily chart, and you know, there's just choppy action. This is the weekly chart. You know, it's just to me, this looks like a very sloppy base, and so I think it's failure prone. But I think if you're going to short it, you have to short it into these rallies. And I did test a little bit of this out over the last couple of days, and it came in a little bit. Nothing to write home about, but you know, it looks kind of weak. So just keeping an eye on these. But again, I still think it's a little bit early to be trying to get aggressive on the short side. I'm going to go through some questions here. Let's see, Kihu 360, someone asking about that. I'm not sure what you want us to answer there. The stock's had a sharp run up and it's pulled back. It's filled the gap here and it's holding the 10-day moving average. Are you using the 10-day moving average here as your stop, Dr. K? I don't think so, right?
Right now, this would have to. I mean, it comes back to how many weeks it's been going, and really, it's 1, 2, 3, 4, 5. No, we still. Well, no, it's not. We're not at 7 weeks yet, so we would still be using.
But the 50-day is below this breakout point on the base, so it's a little bit problematic. But you know, we can't tell you whether it's going higher from here or lower from here.
The 50-day will catch up by then. I mean, the stock's not going to just go straight down. I mean, if it did, you'd be out of it anyway. But over time, the 50-day will catch up. And you
and then you're using it that way. Either that, or it's going to start following the 10-day in a few weeks, and you follow that, I guess. But you know, I think from my perspective, the way I would have approached a trade on this, I did like it right in here as it was getting tight, and then the next day it broke out and ran up. If I own this, I probably would have been selling into this gap up because you're running up. You know, what do you got on this thing? 20-30% on the upside, and in this market, that might. My method has been to take those profits when they show up and just hit them. And so I think that is the prudent way to handle some of these things. SNTS and Jazz acting okay. Yeah, they're picking up the volume. You know, the question is, I guess you'd be using the 50-day all the way down here as your ultimate selling guide. But you know, I don't know if that necessarily is what you want to be doing, because it should be holding this gap. And if you figure that. Here we go. Market's starting to come off a little bit more, but you know, if you're holding, it filled this gap after they announced a secondary offering, and now it's pulled back here. So I guess, you know, I don't know. You're using this low perhaps with some porosity as your stop, but you know, that's a stock that gets some support there, but. You know, is it going to take off from here? And do you buy into this? I don't think so. I think you got to be cautious. And if you had sold it earlier, I don't think I'd be buying them back. But you know, when you're mentioning stocks that are acting extremely well, you're telling me stuff I already know because I've already run through all these stocks, and I can see what's acting well. BPZ, that didn't really come off and held the 10-day, so it looks like it's trying to get a weird kind of pocket pivot right there. You know, LGF gets support there, and on the pullback, and you know, that's just kind of like coming out of nowhere, and so that's a tough tough situation to try and sit through. But if you've got a nice cushion in a stock and you're able to sit through it, you know, you can do that. But Ryland, kind of pulling in, not really getting much support. You know, I'm not a big fan of the builders. FBHS, Fortune Brands, trying to hold the 10-day. So, you know, a lot of these stocks that are extended have pulled back and they're trying to hold in. If you have a big cushion and you want to try and sit with them, you can certainly do that. And you know, for my money though, I'm taking profits as things are streaking to the upside, and I'm selling into that for the most part. Illumina, trying to hold on to the 10-day, but you know, it's way up there, so there's some room to kind of see where these things go. I really think it's dependent on how much risk you're willing to take, how much of your profits you're willing to give up, and what you're willing to sit through. So if you don't have a big position, you have an average size position, you might be able to sit through this if you've got a decent cushion, because I don't think there are any other buy points along the way here. Let's see, moving along here. Somebody says you also have shortsqueeze.com for info. Yeah, that works too. Are NASDAQ short interest figures better than MarketSmith numbers? Well, seeing as how companies are required to report their short interest to the NASDAQ every so often, I would probably trust that as the original source. So, is the higher volume on the indexes we're seeing today considered churning? It's really hard to say. I think what would you say, Dr. K? I mean, if you're looking at volume today, how is that churning? You know, churning is when you're up here, you see higher volume on the day, and you don't really go anywhere. So what you're seeing right now is volume picking up today, and it's trying to get support off of the lows. So I don't really see that as churning.
Is high volume with little price progress, and
right,
usually it's a very narrow trading range, and the volume in my studies has to be quite a bit higher than the average. So I know IBD differs from me here. They call a lot more churning days than I would, and I just found that if I count those churning days as distribution days, it doesn't work very well. You tend to get more sell signals than you should, and so you know. Then I worked this out some time ago. I define what churning is based on where the volume should be, and that seems to work very well in terms of counting those as distribution days.
Right, and the index is not in position for churning. So you know, this is not the kind of position where you see churning. Churning is where you're trying to move higher and you see the volume pick up and it sort of grinds around a bit. So I would say go reread O'Neill's book. So proof that a little knowledge can be a dangerous thing. Let's see, going on. Let's see more. Is Japan's central bank policy and current market break a sign of what we have to come? It may very well be. I mean, who knows? But I think it shows that QE creates a dangerous environment. Was there any catalyst, Dr. K, for the sell-off in the Nikkei overnight? Was there something else? I didn't see anything. It just seemed like kind of broke out of nowhere.
This is a combination of news from the Fed and also the Bank of Japan, and then the weak Chinese data. I mean, just all kind of piled on at once. And also taking into account that the Japanese market has been going parabolic just about, so it needed an excuse to relieve some of that pressure, that overbought pressure.
Right. Yeah, and maybe that's what happened. So maybe our market's susceptible to something like that. But I guess they had a big outside reversal yesterday. And then you break down here. We didn't do that today, but you know, I think the U.S. market might benefit from some money flows coming out of other areas, like say Europe, which was down pretty hard. They closed down pretty hard over there too, didn't they?
Yeah. The average bourse was down around 2%.
Still popping through ALK. I think ALK should have been sold a long time ago. Here you have a breakout and it fails. Goodbye. So you know, I'm not. If you're in that, you've been sitting too long. Lulu is, you know, this is a little bit funky. It pulled back to the breakout point, and it's hanging out, and you're not really seeing a lot of volume. So to me, this is kind of, you know, we had a little bit of this. We just sold it. You know, I'm not going to sit around. It's not going anywhere really, and it looks in this environment like trying to sit on longs too long might be a dangerous proposition, so I'd be wary of that. But I don't think it's a short, so. Lulu short, yeah, okay. No. Let's see, Regeneron. I think, I don't know, I'd be using the 10-week line on this one, so I would have probably been out of this thing in here. And it's pulling back. What's your take on this, Dr. K?
Yeah, I didn't like the gap down action at today's open. I know the markets have been pretty sketchy the last 2 days, and REGN has had a good run up, basically 50%. And
Yeah.
so, but I don't like gap downs. It's just in general, as a general rule. And right now, though, it's stabilized and it's retraced some of its losses. So at this point, if you're still sitting in your position, I would sit. I would wait and see what it does from here. It could very well stabilize and then go higher, as it's done in the last several weeks.
Lumber liquidators doing a similar sort of thing, but when these stocks do this, it's hard to say. You have a gap down on heavy volume, which doesn't look so great, but you're using the 50-day as your selling guide, so there, we can't tell you whether something is necessarily going to go up or down from here based on this action. You kind of have to decide what you're willing to sit through before you pull the plug on it. So you can't tell anything from this action other than that it got support off the lows, but there's no logical area in here that would provide a reference point for a buy signal or buying into it. I think really what you're looking at is whether you want to sit with the position based on the action right here. But so far, if it closed in the upper part of the range, then you might consider hanging on if that's what you want to do. So let's see. You mentioned that Apple's future was a depressing 240 a share. Is that due to the lack of innovative gadgets that they have to offer? It's actually based on somebody's calculation looking at companies' valuations on the basis of their return on capital. And what you're seeing in Apple is their return on capital is contracting very rapidly. And so what's happening on that basis, it's giving you a clue that it might be worth a lot less than it is. I personally think the stock's going to shock people by how far it goes, how much lower it goes from here eventually. Now that's going to take some time, I think, but we'll know in the next bear market what happens here. But I think the stock, the company is slowing down considerably. I don't know if anybody's tried out the new version of iTunes, but boy, that's a piece of garbage. And they just complicated everything. Now they're working on an iWatch, and I kind of have to ask mockingly, okay, is that going to come with a choice of 1-inch or 1.5-inch screens? As if I'm not blind enough at my age, having to use reading glasses now. But you can see the market just kind of flopping around. So again, I'm still a little bit cautious about trying to be aggressive on the short side. I think you'll get that chance later on. And when Dr. K and I both feel that you're in a real optimal spot to be hitting shorts, we'll put out some short sale setup alerts. In the meantime, to me, it just seems kind of choppy. The thing to do this morning was take profits off the opening on the LinkedIn undercut of the 171 area and the Apple off the 50-day, and then just see where these things go from here. Anyways, FLT. What I'm noticing on this one, it's trying to hold up, but they sold into the gap. And you've tried to move up a few times. You had some heavy volume selling in here. I think it needs more time. And so if you buy it in here and you're not going anywhere with it and it's just sitting there, why hang around? Just blow it out and wait for some sort of action that might show you their strength coming back into the stock. So better, like we said, better to play it safe than stick your neck out too far, given the way the action is right now. And like I said, the MDM, the market direction model, is on a neutral signal. What's the distribution day count, Dr. K? Isn't it 3 on the NASDAQ right now?
That's right.
Okay. Somebody says, on the buyable gap up, how far below the low of the gap day do you place your stop? That's obviously somebody who hasn't read any of our books. You allow for some porosity in some names. Dr. K, you want to explain that?
Yeah, and we talk about it in the FAQs as well. If you type in buyable gap up, sell rule, selling. Essentially, you take it's in context with the volatility of the chart. So, and it's also in context with how the buyable gap up occurred. If the stock was going from the lows of its base straight up to new highs and then gapped up, and it was a sharp gap up, you might give more room to undercut the lows of that day. On the other hand, you also have situations where the stock is very volatile and choppy and gaps up, and for those stocks you're going to want to give a little bit more room, again in context with the chart. So you're not taking an absolute percentage, you're taking an amount that's in context with the overall chart pattern. And other than that, there's a rough rule of thumb I use that's 1 to 2% undercutting the low of the viable gap up day, because that does tend to apply to most stocks.
Yeah, so I think the bottom line also is depending on where you buy. So let's say you buy on a day like this. If you bought earlier in the day, you know, by the time you get to this low, you're maybe a little, you're not really underwater by a large amount if it drops 1% or 2 below the day of this intraday low. If you bought up near the peak, you know, it might be a different story. You have to control your risks differently. So, you know, judgment is required. Judgment and experience in the markets are very useful things. And I know a lot of newbies come in and they want everything defined for them, you know, in black and white. And the market doesn't really work that way. Over time, you need to be able to develop judgment and understand things within context. It's a lot deeper than what you might hope for it to be. And I notice a lot of newbies come in and, you know, like someone asks me, you know, how do you pyramid positions and all this. And it's really a matter of your experience, your trading style, how you buy stocks, what the size of position is, blah, blah, blah. And the same thing goes with how you might handle a viable gap. But there's a lot of contextual factors to take into account. The most important in my mind is where you bought the thing during the viable gap up days range. If you bought it near the lows, you might be able to sit through a little bit more of a move below that intraday low. And if you bought it near the highs, you know, like we're showing with this example for, you could use this one too. If you bought up here, you know, you may not want to give it much room, but if down here you've got some nice nice cushion if it does drop below there. And Acadia hasn't, so you know, you have this nice breakout here. It's pulling in. To me, it looks like it's acting normally. And you look at the weekly chart. Yeah, it's stalling out because of the market. This one, it's hanging in there, but I don't really like. If I bought this breakout, I'm selling it immediately when it fails, and then I'll revisit it on either on a pullback or if it sets up at another buy point. So that's how I'd handle it. But you know, if you bought down here on the basis, say, of the viable gap up somewhere around the 12 level, you've got a little bit of cushion to work with. My general routine, though, is if a stock breaks out and it can't hold the breakout point, I'm just gone, just like that. No questions asked. But I'm willing to come back and buy the stock if it starts to act right again. And I don't care if I buy it a little bit higher than when I sold it. I know some people, for what I consider silly reasons, have a problem with that, but I think that's your own problem and doesn't have any bearing on whether you're going to make big money on the stock or not. So, okay, my prediction on Tesla so far is coming true. Oh, look, we just even had some news on it. You heard that woman's voice. CEO Musk appeared on Bloomberg TV. Nothing major to report from the interview. I got to say, though, Elon's looking pretty good these days, don't you think, Dr. K? Of course, when your stock's rocketed the way his has, and in a lot of ways he's been proven, I guess, sort of vindicated in some ways, and also paying off their loan instantly and doing the smart thing by taking advantage of the higher stock price. I think he's looking pretty good these days, don't you think?
Yeah, no, I mean, he's very switched on. You know, we've had extensive chats in St. Bart's, and I was impressed with how open source his thinking is about all the possibilities and how they connect together. And his questions toward me in terms of my scientific background was just very bright and insightful into what we were discussing. And you know, that he exemplifies this open source thinking in terms of where his mind goes in the technological landscape. I mean, everything from reusable rockets to PayPal to Tesla to SpaceX and a number of other projects.
Yeah, and I don't think he liked to really. I don't think he liked having to take a loan from the government. But you know what? Ford took an even bigger loan and $5.9 billion, and Toyota did as well, $1.6 billion. So he probably figured, well, you know, we need this to get this off the ground, and he took it, but he paid it off very quickly. So I think that's his credit. Anyway, somebody has a question here. I think this is indicative of a lot of people's experience. Gil, I had 5 stocks yesterday with profits of 8%, 8%, 6%, 4%, and 2%. Today they are all down another couple of percent. Should I have taken some products at end of day yesterday considering the market? I'm assuming products, you mean profits. And I think that's all dependent on what you're looking at. Like I've been saying, my position has been, for example, in handling a position like DDD, and this is the way I handle in my own account, because I'm running a big position. This thing gets a nice move, and on this gap breakout, my view is that it's coming straight up off the bottom, and you're coming out here. Everybody who reads IBD sees the breakout. Maybe they're going to try and buy it there. I'll back away and then look to buy back on a pullback. And so the way I handle this in this market is to be more aggressive and active on the sell side and taking profits when I have them. So if you're running little positions, 10% positions, you can hang out and see how things go and let them fly around, I guess. I don't really like to sit around too long, and neither does Dr. K when we see a big outside reversal like yesterday. To us, that tells you at least in the near term the market's going to need to flop around a little bit. There will be some stocks that will continue to act fine, and we'll keep an eye on those. But I think it's just a matter, I can't tell you directly whether you should have sold them and taken profits. Obviously, if you're able to invest on the basis of hindsight, you could have sold them all yesterday at their highs, and then this morning you could have bought them all at their lows and bought them all back, if you're using hindsight. Unfortunately, we can't invest that way. So what you should have, would have, could have done is kind of irrelevant at this point. It's really a matter of managing risk in real time and not looking backwards and saying, oh, should I have done this? Obviously, if you're asking me if you should have sold them, if I'm looking at what happened yesterday, well, of course, you fool. Why didn't you sell everything yesterday? I mean, I can tell you that now, but I couldn't tell you that yesterday unless I understand what your risk tolerance is and where your entry points are. I can tell you this much, that in our managed accounts, we blew out all our positions. I think we had 5 or 6, and we just decided we're going to back off here and not allow ourselves to get in trouble. Because my experience in the market is that if you can keep yourself out of trouble, there is going to come a window of opportunity where you're going to make a fair bit of money fairly quickly, and you always want to be in position for that. And so, we backed away from there. We also sold half of the UPRO that we had in the accounts that invest in the ETFs, so do the VMAPs programs A and B, just to be cautious. And then this morning blew out the rest on the switch in the model to neutral. But that, it's just a way of handling the risk and taking caution at a time when the markets are not exactly behaving themselves. So I don't know, market's starting to look a little bit flaky here. Just watching it come off a little more. You can see the LinkedIn, they're kind of edging down, but nothing major yet. They could just easily turn on you. So just kind of keeping an eye on these. Let's take a look at this 620 charts here. This is the real-time portion of our webinar. For those of you who are watching this later on the recording, this is what you're missing. But you kind of see how LinkedIn gets a little support off the lows. I've been noticing that they don't really seem to want to sell it. Now, Apple, like I said, it's going to 240, so that's getting a little bit weaker here. And I think that you're seeing selling into this rally, which was caused by another analyst upgrade. So analyst upgrades are very good for that. But you can see how the 620 would bring you in here, and it's working a little bit. So, but I'm not breaking out the party hats and the champagne just yet. Somebody says flash crash today in AEP and NEE. Wow, that's pretty wild looking. What was that? Let me guess. Let's see. I know that the utility index had this big break this morning. I don't know what that was all about. But I think it is telling you that, same old electronic markets we've been dealing with for a long time. Let's see. Hard to use anything but mental stops with these kind of disasters. I think that's just, with what happened with the utilities this morning. There's a number of utilities that got a clock like that. I think that's just a function of electronic markets and the risk that's inherent in a lot of these things. Someone says, as O'Neill disciples and successful traders on your own, would you attempt to buy the dipped unfavored stocks on a day like this, or stick with your rules and only buy pocket pivot, Bible gap ups, and breakouts? I think you're trying to catch a falling knife. And so, you could use a 620 chart, trying to buy. It's one way to buy stocks. I'll give you an example. Looking at Tesla, right off the opening, you had a 620 buy, and the thing never looked back. So it's one way to buy these things on the pullbacks. Let's look at Triple D this morning. Came down and right at about 7 o'clock. This is Pacific time, not East Coast time, so this would be closer to 10. You can see you have the turn there. So if you're going to try and bottom fish, you could try and buy them on that basis. But I would have to say that's a little bit risky, and you have to be kind of careful on that. And obviously, if it breaks down, you know how to use this chart, you would sell on that. And I think that's a critical thing to keep in mind. Seeing Apple coming off. Notice how Tesla doesn't want to sell off. That's because the whole world is shorted right now. So there's nothing, but there's no natural sellers left. There's just dumb shorts. Let's see. But in general, I think we would stick with our buy points. How about you, Dr. K? Are you a bottom fisher?
Yeah, and I've never been one. Don't plan to be. And good way to lose money quickly.
Well, like I said, if you're familiar with this 620 chart, it's a way I've used to short things that are rallying, and I guess you could use it in reverse to go long things that are breaking down if you think you might get a bounce. And I was sort of looking at that on some stocks, but I got to say Tesla's my favorite stock right now just to trade. It's really fun. Let's see. Somebody says iTunes was great, now it sucks. Yeah, I don't know. It's like what I've noticed is that I have my music that I purchased on iTunes, and that's now stuck in the cloud, and whenever I pull it down from the cloud, it gets rid of all the music that I burned into iTunes off of my CD collection, which is about a 30-year-old collection of CDs that it's like 3,000 CDs or whatever, and that I spent all that time burning in to my iTunes, and now for some reason I'm unable to get to it. And I haven't had time to call up Apple's support and ask them what the hell is going on. But I think they're screwing up, and I think that the company's got longer-term problems. So, anyways. But that's going to be a nice short at some point, and a fat short at some point that I think you want to keep an eye on it. You can see it's trying to come back. You don't really see anything break down here. Someone's asking about Yandex. Well, Yandex isn't one we ever would have bought. It's a crazy move out of here, a gap up move. I guess you could have called that a viable gap up, but it's a really lousy position in the base, and now it's pulling back. So it's getting some support. So I don't know what to tell you. There's no buy point here for us, so we would not be buying it. Let's see. Are you hedging UVXY tonight? What does that mean? I don't hedge UVXY. We either buy it or we don't. But I'm not going to buy UVXY to hold overnight for a gap down. You already had a gap down today. I don't think that that's necessarily the greatest trade right here. And it's interesting that now everybody wants to go short. So I remember yesterday on the chat room I was talking about shorting LinkedIn and hitting Apple, and most people seem to think that you want to be shorting on the gap down this morning, which I don't think is really what you want to be doing. Alkermes was breaking down, and now it's just back above the 10-day moving average. So I suppose if it closed up and the volume was higher than this bar right here 4 days ago, then you would have a pocket pivot buy point. Do you consider today's price action on LL to be constructive? How about it, Dr. K? What's your call? Is that constructive?
Not particularly. I mean, you had the gap down, and now it's trying to retrace and fill the gap on volume. If it can, then it becomes more attractive. I mean, it would be then a pocket pivot of sorts, but it's a pretty wide-ranging pocket pivot. So there's, in other words, some volatility caution. If you're sitting in the position right now, I would still sit because it could very well move a little bit higher, but there was nothing wrong with selling it out, on the move this morning, because some of these gap downs can get a whole lot worse, and of course some of them will stabilize, but I generally prefer to take the risk off the table when the stock does something wrong, like it did this morning.
Workday. What do you think of Workday? I thought it was interesting that it's hanging in there after they beat by 3 cents. They only lost what was it, 15 cents a share, and they were supposed to lose 18. Whoa, I'm all over that thing, and now it's all over the place. So I don't know if this closes up and above the 10-day moving average, Dr. K, and the volume is higher than yesterday's volume. Would you consider that a pocket pivot buy point?
It's not a good pocket pivot because it's a sloppy pattern. It's an IPO. It's not earning anything for the foreseeable future, for the next 2 years at least. And institutional sponsorship actually dropped a bit last quarter. And yeah, I mean, it's got a lot of flaws. So I would not be interested in this one.
Somebody asked if Amba, I like Amba. Sounds like some sort of Caribbean dance, but Ambarella. Is it acting normally? Where's the question? After a Bible gap up. Well, here's your Bible gap up, and it broke down several percent below the intraday low. So no, why would that be considered normal? That's actually pretty pathetic. But you know, it's going to shake you out and head right back up. I think I probably would have been out of this thing yesterday, but you know, today you can sit through all this, and I guess you'd be using the 50 day as your ultimate selling guide. But I would say that is not normal action for a Bible gap up. How about you, Dr. K?
Yeah, it's again, this is a bit of a sloppy pattern. I'd be pretty cautious here. It's not even a small cap; it's more on the border of micro cap. So that makes me less interested in this kind of market environment. You know, until we're in a really proper small cap favored environment like we saw in 1991, I would shy away from the smaller cap names.
Jazz. What's your take on Jazz?
Well, it didn't quite make the pocket pivot, and it gapped down after earnings. So I don't like this one.
No, it is breaking out though. But
yeah,
you know, even if
do whatever it wants, not so interested.
Yeah.
It's because the odds are against us.
Dr. K, are you back in cash? Somebody asked, or is that none of their freaking business?
In cash.
Dr. K, what is your style for handling positions these days compared to mine? Like
well, these days, I mean, in prior markets, better markets, 90s markets and earlier this decade, I like to hold a number of names and spread the risk around, and I could switch in and out of names fairly fluidly so that it wouldn't impact my performance. Still be able to get the triple-digit returns that I could get in an open window environment. But these days, there's very few names that are worth buying, and so what I tend to do is be exposed to the markets on smaller levels. You know, I used to freely go well in the margin, maxed out. These days, I find myself fully invested for me is 100%, not 200% long. There simply doesn't seem to be enough names to be that should be bought this year, last year, or the year before. And 2009, we all know that was just a junk off the bottom-led rally. So you know, it's been challenging, unusual times, and that's where our styles differ in the sense that I'm not going to plow into one name. I'm going to see, and organically get involved with the market if enough names start to issue buy signals. And meanwhile, I was fully invested recently because of the market direction model. Sitting on my my ETF for a number of weeks, and not a whole lot to do except ride the signal and ride the trend. But it was only recently, also the last several days, that a number of good names started to come around the right side of their basis and issue buy points, and they started to actually work. But then, of course, we had what happened yesterday, putting possibly an end to the current uptrend. But we'll see what happens in the days ahead because QE is still in force.
Yeah, and just so you know, fully invested for me is 400% on an intraday basis. So, I mean, when Triple D was running up, I'm long like 120% position there. So, it's just different ways of handling it.
Yeah, I mean, what the bottom line is, how was your risk reward during the year? What were you up for the year, and what was your risk? The risks that you took to get there. And those are really the two most important statistics you need to know about your own portfolio.
All right, and I would say in this environment,
that risk better also match your own trading personality, because otherwise you're going to do the wrong thing at the wrong time.
Right, and I can just tell you I'm up very nicely in my own account using this method of aggressive long positions at the right spot, and then selling into the streaks, and it's just worked very well. You can see the market's coming back. See, it doesn't really want to let go, and while you maybe aren't going to make a huge amount of upside progress here, and things are going to flop around, I also don't think you're going to make a lot of money on the short side. We can see how Apple looks like it's going to start to break down, and it doesn't really. And LinkedIn sort of coming in, but the meat of the move has been over the last couple 3 days. Somebody says, if Workday institutional sponsorship dropped, then why is it going up? Well, a couple of things. Institutional sponsorship, having more funds in a stock doesn't necessarily mean that it's increasing. If you look at the data, it's only current through the middle of March, so it's kind of late at this point. But I'm assuming what you're referring to on Workday is the fact that at the end of December, 392 funds owned 20 million shares. At the end of March, 331 funds owned 20 million shares. So you can see that fewer funds owned the same amount of shares. So it's not like they're dumping it. It looks like there's a switch in the number of funds owning it, but the ones that did own it or either came in to buy it bought more. So the amount owned by mutual funds remained constant. But I would also point out that you can see stocks go higher even as institutions are cutting back. I mean, I've seen that happen before. But remember, this data is late at this point. It's a couple of months old, so not really relevant. And you would watch the price volume action on the stock because if you look at Workday, the reporting, it bottomed out at the beginning of April, and it may have been that institutions started to come in there. Those numbers would not be reported yet. So. I don't know how you do it, Gil. 400%. God bless. Well, it's like it doesn't matter if I lose my entire account. How's that? So I don't really worry about it,
Yeah, I mean it's important. It's not 400% of your liquidity, like your net worth.
Right. I haven't mortgaged a house.
There's people who have their assets spread around, real estate, precious metals, different things, and then you have their trading account. And that trading account can be lost, and they still might have, they have liquidity in other vehicles, and that's a very important aspect to trading because that means you can go in, you can do the right thing at the right time because you're not worried about losing the whole account.
Right, and I think that's when people ask us, how much should I invest? Like if someone's coming into our fund or into one of our managed accounts, and they go, well, how much should I invest? Well, there are minimums, but we like to say, make sure it's money that you can afford to lose. And because if it's not, you're just going to become a big headache for us. And I've dealt with that kind of baloney before. But that's the way I view it. If the money you have in the market, you have to be able to, mentally, I think you have to be able to afford to lose it all. And some people say, well, I can't do that. Well, then what you need to do maybe is use less. And let's just say you had, a couple $100,000 and that's all you have. And I think what you do is keep $100,000 stashed and invest with $100,000, and do it that way. And then if you're worried about taking big risks, then you just go a little slower. You do it more Dr. K style, and if you get a good market environment, you'll be able to make decent progress. See Apple coming back now above 442. Tesla's still going. So
yes, it's important. I mean, ideally, you really should only invest money you can afford to lose psychologically, and be very honest with yourself because. I know there's a temptation to want to risk a lot more due to greed, the need to be in the action, especially when we're in a good uptrend, a strong uptrend. But if you can't afford to lose that amount, then when the market has a negative reaction, you're more than likely to do the wrong thing. You're more than likely to potentially sell prematurely, or you're also more likely to hang on to a losing stock when you should be selling it. So psychologically, I think it's really key to know exactly what amount of money you can afford to lose. Imagine you didn't have that money tomorrow. Would it make a difference to you? And you have to really be soul-searching to answer that question accurately and honestly.
Right. Somebody says Bill O'Neill wrote that if he had a $100,000 account he was trading, he would only have 5 to 7 stocks in his portfolio at any one time. What's your opinion on that? I don't think he's telling the truth because I know when he was running hundreds of millions of dollars, we had at one time we had it almost all in AOL. So I mean I don't know for sure, but I do know that Bill had like 1.5 million shares of AOL at one time. I know Lee Freestone, who's a guy you'll never see at a workshop because Lee is smart enough to stay out of all that stuff. In fact, I remember when, I don't know if you were around when this happened, Dr. K, but I remember when they started doing the Masters series or all the series of workshops that culminated in the Masters program for a weekend that Lee and Al Savoyan, who's another guy who works with Lee, another internal portfolio manager, and you'll never hear either one of these guys, maybe in Bill's books, mentioned a couple times you might see if you're digging for it, but you'll never see these guys sticking their noses out in public because they just trade. And Lee's an outstanding trader, and I know that he was pretty much all in Qualcomm in 1999, and he made a ton of money on that thing. So, I think what Bill's trying to give is guidelines for people, what you might want to have max. Dr. K has his own way of dealing with it. He would probably disagree that you should stick to 5 to 7. We both agree on the fact that it depends on, the risk reward that you're willing to take. Like I said, if you only have a couple $100,000, you probably want to put $100,000 of that in cash and just have that as your reserve, and the other $100,000, you should probably take a slower path and not be trying to jam it like me, because if you lose that, you're not going to be very happy.
But also keep in mind that Bill used to, we had this debate going on in the 90s about how I'd play too many positions, so my system will be too scattered and too slow, and I'll never keep up. And then he had to admit, by 1999 and 2000, I kept coming in #1 in terms of performance. So he had to admit, well, I have a different way of working all these names that works for me that wouldn't work for most traders. And I think there was reference to Lee. Lee likes to focus on just a few names, but if you give him too many names to focus on, then he gets scattered, and it's not going to work for his style. So it's important for everyone to know what is going to actually work for them, how to optimize it. And psychologically, I like to be spread around in terms of my risks because that gives me a psychological strength in running these names and being 200% invested. Back then, people were not over 200%. I don't think you could go over 200%. But you can get pretty wild account fluctuations being at 200%. And for me to withstand those, the way I found in my trading personality was to be diversified between typically 12 to 16 names. And
so wait a minute.
So it's not a slower method per se.
In 1999, what were you up in your personal account?
No, in terms of the institutional account, I was up 587%.
Right, so I was right behind you.
I remember you and I were neck and neck, and we kept competing, and that was great because I remember you said, if anyone's going to beat me, I hope it's you.
Yeah, well, now I'm pissed off that you beat me, but I can say this much. My personal account in 99 was up 1,000%, and I think that's because I only had 2 names, VeriSign and I forget what the other one was, but they were just going bonkers, and I just happened to be in the right 2 names. Had I been in the wrong 2 names, the result could have been different. But stock selection is always key. Somebody says, will you avoid buying stocks that have a high mutual fund ownership? You know what I look at, and because I'm able to track this data, is I look at the funds and I look at when they started building their position. Because most mutual funds are going to hold a stock for 3 to 5 years. And if I see smart funds buying a lot of a stock, over, say, the last 3 quarters, to me, they're just getting going. They're just starting to build their position. And so it tells me that it's likely that they're going to continue to do so, and they're not likely to dump it unless something goes really wrong with the company. And so, see the market coming right back, you guys? So, while we've been sitting here for the last hour, it's been all over the place and making you feel like you want to short it here and there, but, it's still kind of dicey, I think. But anyways, so that's what I look at. I don't really necessarily pay attention to it. I know I did a study back in the mid-90s when I was a broker and I came up with the conclusion that when a stock has 67% or more of its float owned by institutions, it's a warning sign. And I remember a few of the examples I looked at was Callaway Golf was one of them. And there were a few other stocks. I think Dell might have been another one, but that was a study done a long time ago, and just using Daily Graph's numbers, because I used to keep all the old Daily Graph's books that I had, and I could go back and use them for my studies. But when was your last triple-digit year? Well, I almost had a triple-digit month in May of 2010 when I was up like 85% in 1 month shorting. So,
Flash crash.
Fun info. When was your last triple-digit year? Wasn't it 2006, Dr. K?
Yeah, that was the 3 months that I was up about 115%, and since then, there hasn't been the opportunity. The window has not been open for, properly open for 3 months, believe it or not, since that time.
I'm hoping I get there this year, so we'll see, knock wood, but still early in the year. So plenty of time to screw things up. Let's see, is there anywhere online we can find the institutional data? Well, we use one. I think MarketSmith has it. You can also look at Bloomberg. And I also think Yahoo Finance allows you to pull up stocks. Look at Tesla going 90-30 on the offer there. I think the Yahoo Finance also gives you a sense of who owns the stock. But I think markets, not markets, but O'Neill's institutional data, which they get from somewhere else, shows you when funds took positions and on a quarterly basis, and whether they're adding or cutting their position or doing nothing. And Bloomberg, I think, has the most complete data. So those are the two sources. But for the most part, those are only available to institutional investors. But you can always just listen to what we have to say about stocks, because that's one of the things we're always tracking, and we have the resources to do so. So let's see. We're going to have to wrap this up. GPS. What is your take on the GPS chart? Well, you had a Bible gap up and it's holding. End of story. Nothing else to know. Could Tesla be like Volkswagen in 2007? No, I think Tesla is like General Motors in 1915, and you can go to the latest issue, or latest edition rather, of How to Make Money in Stocks. That's Bill's book. You can look at the latest edition, which has an orange cover, and I believe it's on page 14, I believe. There's a chart of General Motors. Very interesting. General Motors came public, went sideways for 2.5 years, and then launched on this big, massive breakout, set up in a base, and then launched even higher, went up 370-something% in, I don't know, what was it, 39 months or something like that. But Tesla kind of reminds me of that, and it also points out that just because a stock has a big move coming out of a base, like Tesla did, that doesn't mean it's over. That's not a climax top, okay? This is your breakout. This is a first stage base. This is a big breakout. For all you know, it's telling you that this thing wants to go a lot higher under the right market conditions. And I think that's really the key here, is understanding that. And I think if you look at that chart, if you guys have that book, I'd take a look at it. Oh, God. What is the criteria that has to be met for you to consider the window of opportunity to finally be wide open? It's not real. I don't think it's something you know ahead of time. I think it's something that you get a feel for as you're taking positions and things start to work more fluidly. And in some environments where progress can be difficult or choppy, you get the sense that the window of opportunity is not open so wide. Correct, Dr. K?
Yeah, it's an organic process, so it's done in real time. You just start to see more and more names that are issuing proper buy signals, and then before you know it, you're fully invested.
Yeah.
And fully invested, I mean on margin. Actually, I should clarify that. You're 200% long. Because that's how it's always happened for my account in the past.
Yeah, so it's not something, there isn't a bell that somebody rings that says the window of opportunity is now open. You kind of just get a sense, and it's sort of a something that's self-fulfilling in a sense. So it's not like you know ahead of time and go, oh, okay, I can blast in and not worry about my positions because the window of opportunity is wide open. That's not really the case. I'm going to finish with a couple of stocks someone's asked about. Gentherm, I don't know much about this. Auto truck, it's a kind of a thin stock. It's just straight up, so I don't know. Tough for me to evaluate. It has 1 quarter up. It's thin as heck. Trades 238,000 shares a day, so I don't know what to tell you about this. Not something I would necessarily invest in because it's way too thin for me. It has decent sponsorship, though. 1 quarter of earnings up, but it's a very erratic earnings record, and sales were only up 14%. So, but in this market, maybe it's going to double from here. Who knows? Let's see. Last one, EFII. Not really too much there. I guess it's bouncing on. Is it a 50-day? No, wait. I'm looking at a weekly chart. What am I doing here? Let's go back to this one. So, here's a pocket pivot on the Gentherm, I guess, and that might be viable, I suppose. But thin stock, not for my not my taste. Let's look at EFII. What is that? Electronics for imaging. I guess you got a little pocket pivot here off the 10-day moving average. Stocks in a base, and earnings up a whopping. I say a whopping 10% in the most recent quarter. I don't know. Maybe that in this environment it works, but it's it's acting okay, and it shows you some technical buy signals. Whether it's the kind of quality you want to buy, you want to pass judgment on this one, Dr. K?
Yeah, I mean, let me see here. I'm thinking, this one had a nice move after its earnings, and then it had a very nice pullback at the 50 days. So now it's going higher. It's a pocket pivot. It's earnings and sales are not blowing the doors off anything. They're relatively anemic actually. So on a fundamental basis, it's not going to be an amazing stock, but the price volume action looks fairly good, fairly healthy
Right.
for this.
You can't fault that at all. So, what would it take to? Last question. What would it take to change the MDM, Dr. K? To what?
Well, to a buy or sell signal. I mean, for a buy signal, you know, we would see the market put in a floor. Maybe it's already done that, and leading stocks would start to recover and go higher. For the other type of sell signal, it would be a you know, an accumulation of downward selling pressure in leading names and major indices. In other words, if we broke below the low of today, that might be enough to trigger a sell signal in the model.
Yeah. And last, someone asking us whether CVRR comments. I don't think there's really anything to comment on this. You had a move up through here, and it rolled over, broke down through the 50-day, violated the 50-day moving average and the 10-day moving average here. So that, you know, it's not something you want to be buying here. And if you did own it, I think you at least got a sell signal in here. So that's that. Anyways, you guys, you know, you get a sense. I still think you're sort of in no man's land a little bit. I wouldn't expect the market to turn around and rocket out of here. I think it's gonna take some time, possibly, to set up. I just keep an eye on stocks and see how they act, bouncing off of logical areas of support. You know, example would be, you know, NSM comes down to the top of its base and holds. If you look at the workday, even, you know, you can see it came down to the top of this base here and held. So, you know, if you can discern spots like this, logical areas of support, and the stocks show some volume, they might be re-entry points. So, but you know, I think you got to be careful and don't get carried away with it. Be opportunistic, but you know, don't get crazy. I think you're still in danger, and I think the Japanese market tells you that QE might be a wonderful thing that produces these wonderful trends, but when they come apart, they really come apart. So, you know, on that note, exercise caution at all times, maintain vigilance, and keep an eye on your stocks and your stops. And that's all we got. We'll catch you guys next time. Take care.
So long, everyone.